Afternoon.
Hello, good afternoon.
Hi, Marina. How are you?
I'm good. What about you?
Yeah, well, thank you. How's your week been so far?
It's been good. It was a good week. So it was a good mix of everything. So I would say that I'm very quite satisfied.
Oh, that's good.
Thanks for asking.
I wish I could say the same. This week's been crazy, but anyway.
Yeah. So how is it? It's Thursday, right? So one day and a half left for you,
Yeah,
right?
exactly. No, it's just one of those weeks where just nothing major, but a few things have gone wrong. And so it hasn't, you have to take it as a learning, don't you?
Yeah, there is no other way.
All
So,
right,
so it
cool.
can only get better, right?
Yeah, exactly. All right, I'm going to crack on. If someone else joins later up, great. Otherwise, people often just want the replay, so that's fine. So today, just going to go through how to prepare for a fundraise, kind of high level on what investor wants, but also how to get kind of the numbers ready because that's obviously my expertise. So just a very quick intro. I need to change this to 20 shortly. Working with startups and scale up since 2006, two successful exits before I went on my own. And since 2019, I've just been working with startups and scale ups. I've got a small team now with lots of specialist skills. Um, this book isn't relevant for founders, but potentially for finance managers and financial controllers who are in your team. I did write a book called Financial Leadership Fundamentals: How to Become a CFO in a Startup or Scale Up. If you do have someone in your team that would like a copy of this book, feel free to reply to our replay emails, and I am very happy to send one out. Um, Okay, so what are kind of the reasons that we've seen where fundraising fails or where founders have struggled in the past or chatting to investors? And these are kind of the main reasons that I've seen. The first one is a weak commercial story. So whether it's the fact that there hasn't been enough research or development on the product, they haven't quite got product market fit yet, or the investor just can't get excited about your kind of business offering, or the fact that there is actually a problem that you're trying to solve. So that's the main thing. And so just being, as a caveat, just being very clear on what that is. The other one is unclear metrics, which kind of also feeds into messy financials. So we have done due diligences on behalf of small VCs firms before. We have unfortunately seen financial statements that are a complete mess, and therefore the investor really distrusts the financial forecast and also the history of what you're trying to tell them. So that can make it really tricky. Also with the metrics, so it's thinking about what is the best metrics that can explain your commercial story. What are you trying to achieve? And the KPIs that you're tracking, are they telling you whether you're going to achieve those goals or not? And being very clear on what your revenue drivers are, and growth drivers. So all of those things are really important as far as KPIs is concerned. A distrust in the leadership team or lack of experience. Obviously, messy financials can exacerbate this issue. So if you don't have a leadership team or your leadership team's very small, make sure that you include your advisors and the people that are working with you into your pitch deck. You want to make sure that it's not just your face on a page because you love what you're doing and that's it. If you think about it from an investor point of view, they want to give people they don't know yet a heap of money to implement something that they say they're going to implement. So you can see that one of the big three reasons why an investor would not invest in somebody is because they don't trust the leadership team. So just make sure that you're very clear on why they should trust you, basically. And then the last one is not a big enough market. They're just kind of similar to be having a weak commercial story. But if they don't think that your company can 10x, particularly the venture capitalists, then they're not going to be interested in you. So make sure that you can demonstrate that your market is really big and the fact that your company can really grow, whether that's just within the UK market or the global market. So investors are becoming more selective. 2021 was a great year for fundraising, and then since then, it did kind of fall into a hole. It has bounced back a little bit. I'd say 23 was a really bad year to invest. There is obviously, we have completed a couple of Series A's and seed rounds, but it is harder. So they are investors are being much more selective, but they're also being a bit more risk averse as far as doing research on you and also doing due diligences. So a financial due diligence used to only be done at, say, a Series B. I'm now seeing it 100% with Series A and sometimes light touch seed rounds. So just be aware of that. So they do, as I mentioned, they do require more today. So these are all the things basically you need to think about at a high level of what you need to do in preparation for that. So all of this should be done within the 6 months leading up to a fundraising or even earlier. And all of this should be completed before you start your fundraising round. Ideally, you want to have communications with investors every day, every week. If you can, one investor a week is a nice goal because it's always easier to speak to investors when you have a warm introduction. It's a warm lead. So as a founder, preparing those warm leads in the lead up to a fundraise is really important. The other reason why it's a good idea to do that is because they will happily give their opinion on what they think about your company. Whether it's useful or not is up to you, but if you hear the same thing from multiple different investors, it might be something to consider. And that is quite useful when you are in the lead up to the fundraising. So high level, what's your vision and mission? Most vendors are very good at this, but just make sure it's very clear and understandable. What's your commercial story? Your finances, obviously, that we'll go through, your budgets, your pitch deck, and your data room. So we'll go through each of those things. Just quickly, just a quick funding stages kind of overview very quickly. So pre-seed, that's usually your family and friends, angels, early stage seed funds. This is much more deck heavy, vision led. You may not have any revenue yet. It's selling the dream. So you're trying to find people that like your vision and are happy to dream with you. You probably just need a basic cash flow plan. You'll need a go-to-market strategy. Explain how far this initial ask is going to get you. You obviously won't need a huge amount of historical information because you won't have it. It's more about the dream. With the seed stage, by then you probably have a product, you have some early traction, you have some customer data. So the investors will expect you to have that commercial story, initial thoughts on unit economics, your monthly reporting, a 3-year budget. And founders would want you to be able to explain some basic financial metrics such as CAC, cash burn, cash runway. And then Series A is your full box and dice. So this is where you will be expected to do everything that I kind of mentioned on the prior page. You will probably get a full due diligence, and that'll include financial statements, 5-year budget plan. You can get away with 3 years if they're US investors, team and hiring plan, board level reporting, all these kind of things that you need to do. I would recommend a finance lead, whether it's in-house or someone like us, fractional CFO, to help you prepare for all of that stuff properly. But I have seen more and more requirements at that seed stage, but it does depend on your industry and how far your product is. If you're still very early in the R&D phase because you're in biotech and you're not going to have any revenue for another 5 years, is probably a bit different than a company that has been around for quite a few years and is only now ready to start with the seed round. Preparation. So, as I mentioned, the vision, the mission, the strategy, just a clear understanding of what it is, super simple. Is there a story there? Often these are your first one or two slides in your pitch deck, but you want it to be exciting and you want it to kind of create the backbone of what you're trying to achieve. Off the back of that, then you'll have your 3 to 5 strategic goals, and this is also part of your story of what you're trying to achieve in order to get closer to your vision and be part of that mission. So it's very important to make sure that you have these established and all your finances, your pitch deck, and your team are very aware of what these strategic goals are. Off the back of that, and this is then getting more into the detail, then you want to know what the operational goals are, or your stepping stones, to implement over the next 1 to 2 years so that you can achieve the strategic goals. And this is really important, not for your pitch deck, but actually for your budget and your financial plan. So in order to say, if one of your strategic goals is, we want to have £1 million revenue in the next 12 months, then obviously there are things that you have to do in order to get to that £1 million revenue. So there may be, say, 5 or 10 goals that you need to do, whether that's hire additional people in your sales team, whether that's get additional training, whether that's purchase some software, whether that is releasing a new product. Whatever it is, there needs to be a plan on what your operational goals are. And then those operational goals need to form part of your budget and your financial plan. You also need to understand it because one of the questions will be, oh, how are you going to get to £1 million revenue? Because you'll say in your pitch deck that that's one of your goals and that's what you're planning on doing. It's one of the reasons why you're asking for investment. You then can very confidently respond that you have a very specific plan on how you're doing it, and you can talk through what your operational goals are and how you're going to get there. And then your budget and financial plan will also mimic that plan. And so therefore everything's kind of coherent and everything's working together. Any discrepancies where the pitch deck says one thing and your budget plan says the other will be picked up very quickly by an investor, particularly in a Series A. It's then honing down your commercial story. So, I mean, I will say most founders can do this already, but if you can't, or if you haven't considered it, you want to be able to explain what you do in 2 sentences to an investor, especially when you're doing those warm leads, that initial conversations with investors before you start fundraising. There is something called a mum test. It is based on a book. It basically says if you explain, if you say these 2 sentences to someone's mum, assuming that they're elderly and they're not in the business world, which it's a little bit I don't know if I like this term, but anyway, if they can pass the mum test, then you've got it right. So I have spoken to EIS angels before. They are of the older generation, and they have complained to me that they go to investor founder days, and nearly all of the new startups are AI, and by the end of their pitch deck presentation, they have no idea what they do and what their business model is. So just make sure that it's very clear that what you do, and you can explain it super quickly and anybody can understand what you do. Product market fit is also obviously the big one, particularly that earlier seed round or even Series A round is really important. You want to make sure that you have proof of your product market fit. So you can ask ChatGPT to set up a test for you. It will know. But ideally, you want to prove that you have product market fit. You don't want to just have vibes. So you want to be able to say, oh, yes, 60% of the, whatever the percentage is, can't remember off the top of my head, but 60% of the customers that we have engaged with would recommend us and would be disappointed if we stopped providing the product or service that we're providing. This is an example of a test that you can do. So, you know, you want to be very, very clear that you have achieved product market fit. There are lots of tests around. Investors are interested that you have gained that product market fit and gained traction, so that if they pour money into sales and marketing as post the fundraising round, you will fly. Or you can be very clear and say, no, we don't have product market fit yet. This, you know, we need to do further tests, or we need to pivot the product, what have you. So just be very clear at what stage you are with your product market fit journey. The investors and the valuation will change depending on whether you have it or not. And we kind of touched on that, metrics supporting your growth story. What are your revenue drivers? What are your volume drivers? What are your customer drivers? And just make sure you're tracking all of those things and they're heading in the right direction. The pitch deck, these are, you know, these are kind of the 4 things you may want to, when you've put your pitch deck together, maybe ask somebody else even. You know, I've certainly done this for founders that we work with, whether you can answer these 4 questions. So why should I care? Why should an investor care about the problem you're solving and the product that you're offering? Is it interesting enough? Why you? So why is your product or service better than anybody else? You know, compare yourself to competitors in your pitch deck. If you don't, the investors will. So make sure you get ahead of the game in that perspective. So definitely include competitors. But why you? Why is your product or service amazing? Why now? Which is a really interesting one. Why are you fundraising now and not in 2 years' time when your metrics look better? What is the urgency? You don't want a situation where and I've seen this, I think this is the hardest one to answer, but why now is why, you know, why should they invest now? And what you might see is they might love your product, they might love what you're doing, but they might say, oh, come back to me in 1 to 2 years' time once you've achieved X, Y, Z. So this is a really interesting one to make sure you include in pitch deck. It's also a really interesting question to answer as you're having those meet and greets before you start fundraising, is learning from investors the kind of triggers that would make them interested in investing in you today. Or they might say, oh, once you've achieved this, come and talk to me. And so you might then change the prioritization if you keep hearing the same thing from an investor. I've certainly had experience with that. We thought growth was the most important thing. We were achieving amazing growth. The gross margin profitability was actually taking a bit longer than we wanted. The investors said, come back to us once we've achieved gross margin profitability. So we had to pause some of the activities we were doing on growth, focus on gross margin profitability, and then get back to growth again. And we completely changed the prioritization of the business. So this is why it's really interesting. I probably should have said number 2, the why you. That's also the trust, the understanding who you are, not just your product and service, but also the leadership team. And then finally, what's the ask? Don't be afraid to say, you know, this, we want 2 million to do X, Y, and Z. It's probably worthwhile having, say, a pie chart that splits how you're going to spend the ask. So if you say, I want £2 million, and then 50% of that will be on sales and marketing, you know, 30% is on tech and product, and 20% is establishing a bigger team and working capital. So just make sure that all of those things are included. And if they are not, and you can't answer those 4 questions, maybe go back and revisit that pitch deck. The finance function. So this is obviously, as I said, this is a bit that I know very well. I will say it's incredibly important that your numbers are clean and trustworthy long before you start pitching. You want to make sure that everything reconciles, that the cash balance in your balance sheet is the same as what's in your bank balance. You want to make sure that you understand your revenue recognition policy. I'm actually recording a video for YouTube on that exact topic today, so that'll be shared in the next 1 to 2 weeks. You want to make sure that that everything works and your gross margins, for example, are relatively consistent. It just needs to be clean. And generally you need basically a good accountant who is managing this a bit better than, say, just a bookkeeper who just pays invoices and that's it. The three financial statements that investors will want to see is your profit and loss, your balance sheet, and your cash flow statement. They're the three. They will want to see that in your financial statements. They will also want to see that in your monthly management accounts. So they will be asking for those three things, particularly at definitely at a Series A, but potentially also for a seed round as well. So you just want to make sure that you have the professional suite that at as a minimum, and also that they're consistent. So what you have in your pitch deck is the same as what you have in your growth model history and is the same as what you have in your financial statements. You don't want the revenue in your pitch deck to be different from your financial statements when you're looking at history, and then different again about what's in your budget. So there is a bit of work there to make sure everything is working. On the budget, you will need about a 3 to 5 year budget model. More and more European investors are asking for 5 years. US 3 is enough. You could get away with 3 years, but it depends on what it looks like, basically. You want it to be quite reasonable, but you want it to be ambitious. So you do want to see a good amount of growth year on year, but you don't want it to look irrational. You don't, that hockey stick growth, you can't necessarily get away with that in Europe if you haven't already seen some kind of hockey stick growth. So with one of my clients, they're in a hot industry. They are currently already on a pretty good journey. They're about 1 year in, and they're already seeing hockey stick growth. So we can continue with that type of growth, and we have the market size to that we know that that is possible. But to say that you're going to have a product launch in 3 months' time and then have hockey stick growth off the back of that, there's going to be a lot of questions, particularly from European investors. But at the same time, you don't want to be too conservative so that it doesn't look exciting. So it's finding that balance between ambition and being too conservative. So just make sure that you are aware of that. You want it to be reasonable. So whether it's thinking about, okay, these are my revenue drivers, this is a product that we know is similar to ones in the market that have achieved this level of growth, we think ours is better, so it might be slightly more level of growth, and you kind of have a step plan as to how you're going to do it. So common mistakes is unrealistic margins. It's saying that you're doing one or two things and your margin just goes through the roof. Unexplainable step changes. So if, say, for example, you have a step change in revenue, but there's no reason, there's no product, there's no change in headcount, there's no change in the processes. You want to make sure that any step change or improvement in your budget, there is a rhyme and reason behind the back of that. Skipped cost. So this is probably more early stage, when you've forgotten all of the different costs that you should include. So make sure that you really think through all of the different steps that you need in order to put a budget together. No headcount details. So you don't need people's names and addresses and date of birth. You just need the titles, just what their titles are. That's enough. And then potentially the salary that you're paying them. So it doesn't need to be more than that. But as you wouldn't provide this early stage, this would be when you're speaking to a founder and you're getting close to a term sheet. You would think about saying, this is the size of the team. We're planning on adding these 5 roles, these 2 roles, what have you. They will be interested in understanding the growth of the headcount. And then finally, no balance sheet or cash flow. So this is just showing your revenue and expenses. Cash is incredibly important at this earlier stage. And cash is actually sometimes more important, often more important than your revenue number. So make sure there is a cash flow included within the budget. These are like lots of metrics. I won't go through them in minute detail. I do have resources that do go through this in detail. So if you need more information, just drop me an email. But these are common ones that we see come up with investors asking questions, again, probably at seed Series A. The first one is CAC, LTV, and ROI. So CAC is basically how much are you paying to acquire a new customer. So it's your acquisition cost per customer. So whether that is quite direct or indirect. So how much are you spending on marketing, sales and marketing, and divide that by the number of new customers is basically what that is. Your LTV is probably Series A, Series B metric. It's your lifetime value. So if you think about one customer, how much value do you get from that one customer over their lifetime that they're with the business? So you would definitely need to be post product market fit, and you would want to have been around for a couple of years before you can start calculating this one. But if you're getting to a Series A level, LTV is something you need to consider. And then ROI, return on investment.
Can I ask you
Sorry.
one very quick question?
Yeah, of course.
Would you apply those metrics also for the B2B, or are they more B2C specific?
So CAC and LTV, I would definitely do B2B as well. Yeah.
Yeah.
So I generally find with your CAC, your sales and marketing cost is minimal marketing, but more a sales team. So then whenever we're reworking a P&L, your sales team, I would separate out from your overheads and I would include it in your sales and marketing costs. And I would look at that. So how much are you spending on your sales team and how much value are they bringing to the business? So if, you know, if you've got one, you should know you've got, say, per sales head can bring in 2 contracts. The salesperson is going to cost me this. The contract is going to cost me this. So my return on investment, or CAC, therefore, is X. So it's worthwhile understanding that calculation, because it's set, you know, if it's heading in the right direction and it's like good, then it's worthwhile. Then is it worthwhile investing in more sales heads, because then the growth will be so big. So understanding that, I think, is really important. Then gross and contribution margins, you know, this is just part of your profit and loss. It just should be clearly visible in your budget and your P&L. But it's just understanding the incremental changes, particularly in gross margin. So if your gross margin improves, why? Why is it improving? So, you know, need to understand the reasons as to why you're becoming more and more profitable. So it's just getting that visibility. So again, appreciate this is very high level, but if you need a further explanation on any of these, just drop me an email. And then finally, cash burn and cash runway. So this is part of your cash flow statement. So cash runway is basically, if I don't get any investments, how much longer can I survive until I run out of money, basically. So if, say, for example, as a very crude example, say you've got 1.2 million in your bank account and you are currently running at 100K loss per month, then you've got roughly 12 months until your company runs out of money, as a very crude example. But generally with fast growth businesses, the amount of cash you're burning each month fluctuates month on month. And so that's why generally you do need a budget model to help you understand your cash runway. But cash runway is definitely something you'll want to understand as a founder, whether you're fundraising or not, basically. So yeah, so that's a very crude example, but it's basically how many months do you have until you run out of cash. Documentation and IP. So this is thinking about your data room. At these earlier stages, you don't need to buy software to create a data room. There are plenty of people out there that have software for your data room. I think maybe Series B onwards, it might be worthwhile in investment, but investors certainly don't expect you to have some sophisticated software. So just having either a Dropbox folder or a Google Drive folder is totally fine. I would recommend that you start pulling together your data room again long before you start opening your fundraise. This is another way of demonstrating your professionalism and the fact that you are trustworthy. If an investor it starts becoming serious and wants to see your data room and you're not ready, then they might put a question mark against your trustworthiness and professionalism. So the things that there's lots of things that you want to include in your data room, and one of the big ones that I will say, or two of the big ones that I will say, is your IP and your cap table. So within your data room, you would include things like your financial statements, your management accounts, your budget, your commercial story, your pitch deck, any legal documentation, any business model calculations, any market research that you've done. These kind of things would go in there. It's anything to substantiate your claims within your pitch deck. But you also want to make sure that you own your IP. I've heard some horror stories from some of my fractional lawyer friends, whereby the business didn't own their IP and they were called in to try and get the ownership. A perfect example is when you don't own your IP is when you have outsourced your tech resources and you don't stipulate in the agreements with your outsourced tech team that whatever they build you own, not they own. So it's a perfect example of when the IP can go wrong. So just make sure you own your IP, your trademarks, your playbook, everything you own. And the other one is you want to make sure that your cap table is quite clean. This is something you can go through with your lawyer, but just make sure that there isn't anything in there that could scare an investor away, or you're quite transparent. So do you have warrants? Do you have options? Do you have any funny shares that an investor might be wary of? Is there something that you can clean up before you go? Was there a co-founder and you're no longer together and there's some hostility there? You just need to work out what is the best way of having a clean tap table. But it does take a bit of time to put a data room together. I do find also sometimes with earlier stages, really important documentation like a lease agreement or a key supplier agreement is sitting in somebody's inbox and it's not sitting where it should be, and you have to try and find all of this stuff to go in the data room. It's best to do that 6 months before you start fundraising than when you needed it yesterday when an investor asks for it. So again, like everything in this slide, preparation is key. I do have investor readiness scorecard. I did email that around. If you haven't seen it, we'll drop it in the chat. We'll also send it out with the replay. It's just 10 questions. It'll take you 3 minutes. It's yes, no answers. And then depending on what your results are, we'll send you some free resources to kind of help you do some self-checking about what you need to prepare on your investor readiness. Obviously, this kind of presentation helps you make that assessment, but this is just like another resource that you can kind of do. What happens in a due diligence? So essentially, investors will they'll look at your books. I'd say probably 50% of it, particularly at a Series A, will be looking at your numbers, and they'll chuck everything, your budget model, everything at a bunch of analysts that they have in-house that'll just crawl over everything. They'll also go through all your legals, and often they'll go through tech as well. So there might be an element of reviewing how secure your tech is, how sophisticated it is, whether it can grow or not. Obviously, seed stage is a bit lighter touch, and obviously earlier stage is even less so. So the due diligence, it might just be, say, checking your IP, your financial statements, you know, and a few other bits and pieces, and then they might do some work themselves in the background, having a look at the market, having a look at your competitors, having a look at what customers have said on Trustpilot, you know, this kind of thing. So it's better to be over prepared than under prepared. I mean, appreciate it takes up resources, and startups never have resources, but it can take anywhere between, I'd say, 4 weeks to 12 weeks. So it just depends. It also depends on the investor. Some investors really get carried away with their due diligence and can really get stuck in, and you know, it takes up a lot of your resources. I would say that both yourself and your leadership team, particularly whoever you use to help with legal, whoever you use to help with finance, they will be tied up for the entire due diligence, and most of the time is just answering questions. So you'll just expect email after email full of questions, and you just have to answer them as quickly and as completely as you can. Ideally within 24 to 48 hours, you try and answer your questions, or you answer the questions that you can and say you'll get back to them on the ones that take a bit longer, and then you just wait for the next set of questions. So that's a bulk of the process. And then obviously it's going through the legal, so their lawyers and your lawyers talking to each other, which takes time, like with any deal. But that's kind of what really happens during a due diligence. Sometimes you need to do face-to-face. They want to just spitfire conversations. I mean, when we had an Amazon acquisition, I mean, it's completely different. I just sit in a hotel room for 3 days and just sit there and answer questions. It's not as scary as that. It's usually just over email. Just very quickly, we do have like a 3-month kind of product where we come in. It's over 3 months. We do a full due diligence. We give you all of our recommendations of things that need to be changed, and we do a reporting upgrade as well, so that they're at the level that investors would expect. So if that's of interest, drop me an email and I'll send you through some more information. But yeah, that's, I mean, there is a ridiculous amount of information in there, and I appreciate some of it might be a bit complicated, but from a high level, that's kind of all of the things that I see works well within a fundraising process. It is a difficult, lengthy process, and can be sometimes quite emotional. So the more preparation you can do, the better. So, but yeah, did you have any questions at all?
Look, actually, this was very exhaustive. I think that I will, I mean, some things might come up. I'm here actually, I'm based in Dubai, and I'm a fractional CFO actually. And at the moment I'm here wearing different hats because one of my clients is actually starting I mean, is at the seed stage right now. So, and we are trying to get him as ready as possible. I mean, I've been working in finance my whole professional career, but I think it's different, you know, to be, I mean, in the FP&A, you know, so, but it's different, you know, to actively live a fundraising stage, or, you know, and that's why I'm trying to get prepared, you know, as I mean, just to get prepared as much as I can. And this is why I mean, I thank you very much also for your availability to hold this with one person. So thank you very much for that.
No, that's fine. As I said, we sometimes get quite a bit of response from the replays, so it just depends on whether people are free or not. So
yeah, no, so this was very exhaustive and very, I would say, helpful, you know, so to kind of, I mean, I have participated at some due diligences, but they were like more corporate, more, I mean, so it's again, it's different to probably prepare a due diligence for a company who is in business since 10 years, 15 years, 100 years.
Yeah, for sure.
Or for a startup. So this, and I mean, as a feedback, this is really, really exhaustive and very, I mean, helpful actually to get prepared. So thank you for that, and thank you for your time.
No problems at all. Well, good luck with your fundraise, and hope this, as you said, hopefully this has got some good takeaways for you.
Yeah, definitely. Thank you so much.
No problems. Thank you. Bye. Bye-bye.
Bye. Bye-bye.